Well, we're getting reactions from foreign investors to the Indian budget, and I have with me a very special guest, Mr. Ajay Kanwal, who's Regional CEO, ASEAN and South Asia at Standard Chartered Bank, and he joins me with his perspective on what the Finance Minister had to say earlier today. Ajay, great to have you on the show. Thanks very much for taking out the time to speak with us. You know, the headline maker's really been keeping 3.5 intact. The grey area there is, will they meet that target in FY17? What's your sense?
So first, I think we must give the finance minister credit that he's said he will maintain 3.5. I do think there is a risk in execution, which everybody seems to be talking about, but I'd rather take the risk in execution rather than take a weaker number. So from my perspective, I think it's fabulous he's done 3.5. I do think that it gives us an opportunity now to think about rate cuts, because that clearly is the next option, which is if you're maintaining financial discipline, inflation is managed, then let's now think about rate cuts. So I do think that's a very good move.
But how much can rate cuts do the trick, which we've already not seen come by through the 125 basis points that have been given to the economy? So it's monetary policy support, but there's also fiscal measures that need to be put in place to push the economy.
So I think on rate cuts, really, I feel that to make India competitive, there is clearly a longer-term journey of bringing down the whole cost of doing business in India. Interest rates is one factor. I think where inflation is, and with fiscal deficit being maintained, I think better chance of rate cuts. I think the big thing is, how do you make the rate cuts pass through? Both to the banking system, which we should see on the government yields, and then to the clients. So I think those are two key pieces. But let's look at any budget. Budget is not like a one-year answer. So I think a budget is a journey in a series of steps you need to take. I felt the finance minister has been pretty consistent and in the right direction. Will one budget solve it all? Certainly not. But I think a few right steps certainly has been taken.
But what are you expecting in terms of monetary policy support from here on? You said rate cuts. How many rate cuts do you think would infuse that confidence that, yes, things can look up? Because transmission, like you said, is a problem. So yes, the government has kept to its target. They are managing their finances in a disciplined manner. But how much can the RBI do to push growth?
So I think two things. One is India as an economy is ready for the interest rate cut environment. I think the budget helps it. I think the other thing I would watch is what happens globally. So I think the big thing is, does the US have the one increase possible? What happens to the China interest rates? So I would not hazard a guess of how many interest rate cuts, because if I was sitting in the governor's shoes, I would make sure I understand what India is doing, what's happening globally, and I take it.
China they've cut the reserve requirement ratio again. They're in easing mode, so they are successively coming out, and they've already indicated to the market that we're going to go lower on rates. We're going to go lower in terms of infusing more liquidity into the economy. So that's well documented. What would be the response, an apt and prudent response at this point in time?
So my own sense would be we will need a small dose of that ourselves back in India, and I think that will help a lot. And sometimes it's not about the quantum of cuts, it's about the confidence it infuses or the direction it sets. So yeah, my take is not getting so focused on how many cuts, but one cut, getting the direction right, making sure it passes through, I think will be very good.
Why will achieving 3.5 be such a challenge? Many are questioning the revenue growth target of 14% for next year being a bit difficult, a bit ambitious. Do you feel that as well?
Listen, I haven't read through all the details, but my little sense is some of the gains are a little bit transactional or episodal, So on the gain side, or where do you get, how do you meet your deficit, it does seem to me that we have a little bit of chunky answers and not regular flow-through answers. And that makes me feel a little bit nervous about the 3.5 being maintained.
What about nominal growth of 11%?
That should be reasonable is my view.
Okay.
That should be reasonable. But you should watch the execution of maintaining 3.5, because the risk we run is we are not maintaining the revenue side, we may cut the expenditure side, and we may see a drop in capex. So that bothers me a bit.
You were talking about the tax amnesty, which perhaps has been an innovative addition this time around. That could bridge the gap in terms of getting additional revenue via the tax route?
Yeah, so I think the tax amnesty, to my mind, is a very good idea. In many ways, not deciding whether we should introduce it now or next year, but I think really, getting more people in the tax net, getting more money in the real economy is valuable. I think really that's one area the finance minister should press very hard. Not only is money coming in this year, but what it does to new people entering the tax bracket or the tax net over a longer period of time is also very valuable. So if you ask me one real interesting event that could happen, which would be very positive, would be really making that scheme work very hard. So I would really hope that that is something that we focus hard on, make sure we advertise it enough and get a lot of tax, more tax into the system.
The third leg is, of course, one is on managing the finances and pushing growth. The third aspect is the health of the banks. And many are saying, they've undershot on what the market was expecting in terms of recapitalization. But, what I read into the lines is that the commitment holds, and that, as and when there is requirement, consolidation would be the way forward.
So, my impression is very similar, which is rather than putting down a certain number and saying, here is what we will all commit to, I think he's left it very open and committed to making sure that he works on the capitalization as and when required. I didn't take away a negative sense on the bank recapitalization. In fact, I did sense a bit of strategy around consolidation and getting it right. So I'm more positive that that will be sorted out.
I know you handle a lot of big money through your clients and they're looking to invest in India. What was the sense that they had before getting into the budget? And how do you think this budget has kind of fared in terms of matching up to their expectations?
I think the 3.5 discipline would have been very positive. On the not so positive side would have been if at least we didn't give a corporate tax cut, at least a roadmap to be identified and put in place would have been a nice step. So I think that would have been a not so positive. But listen, you should look at India not just from an India perspective, but from a relative perspective. So how is the world doing and how is India doing? So I think from that perspective, I think India is in good position, and the budget actually keeps us in that mode. So the budget doesn't really put us in a position saying, oh, India look positive before the budget, after budget it looks not so great. So I think that we should take away, saying India does maintain its position as one of the brightest spots in the world, both of growth, of fiscal discipline and opportunity. So yeah, we can argue whether it's perfect or not, but I think if you take on a very macro basis, I think it's positive for India.
Ken, it's great to have you on the show. Thanks very much for taking out the time. First, your initial comment on how you saw the budget. What did you take away from it as an investor? Because the markets are rallying, the equity markets are rallying, the bond markets are rallying, and the key headline coming out of the budget is the government is going to keep to their fiscal consolidation plan. They're going to keep to 3.5% for FY17.
Yeah, so I mean, I think the market, we're pleased with that budget. I think similar to the market expectations, we've been starting to expect the budget to come out higher than 3.5%, maybe 3.7, 3.8, largely because we anticipated that there would be additional spending on all these sort of key areas that the government is focusing on, agriculture, rural sector, etc., etc. And because of that, the market had started to anticipate that there'd be greater bond supply coming to the market, and that had been putting pressure on bond valuation. So clearly now that the market has seen that the consolidation profile is going to be maintained, there's some confidence returning to the bond market, and it's definitely by Indian standards, it's quite a strong rally today.
Yes, indeed. And do you think the markets are rallying because they're relieved and they went into the budget with very low expectations, or is the rally in anticipation of more rate cuts? We've seen 125 basis points, but there's enough and more talk about what will the RBI do next.
Yeah, I mean, probably a mixture of both. Part of it is relief that we've seen this fiscal consolidation path maintained, but part of it is probably because it reinforces the fact that RBI now has greater room to ease policy, and to a large extent that can still get priced into the bond market, which slightly is decoupled from the RBI policy.
You were saying an interesting point. You were saying that at Aberdeen, you were expecting a rate cut, irrespective of whether they kept to the 3.5% target or not. Even if they came out with 3.8, you were still expecting more monetary support from the central bank.
That's right, because I mean, growth pressures are more negative than what the headline growth numbers suggest. So the underlying growth momentum is actually quite poor. I think both the government and the central bank understand that, and there has been a great need for some support to the economy. So the only question was timing and magnitude. So this reinforces that we can see a rate cut sooner than potentially anticipated, and we can see probably additional easing on top of the next one as well.
So what's the looking like? Because we've seen 125 basis points.
Correct.
There was expected to be some fiscal support in terms of higher spending. That's not come about. So does the RBI compensate for that with a more monetary easing on the rate front? How many more?
They definitely
rate
have
cuts?
room to. So we think they'll ease at the next meeting, which is coming up in roughly the next
25 basis
month.
points
Correct.
then, yeah.
And then we expect to see another 25 basis points in the balance of 2016 after that.
In total, 50 basis
50
points
basis
in the
points
works?
this year, yeah.
Could it be more than that?
Potentially, but that
Does
would really
India need
depend
more than
on. It'll partly. It depends on a lot of factors. So you have to look at how effectively the rate cuts are actually getting passed through to the economy.
The transmission process.
The transmission mechanism, exactly, and that hasn't always been very effective. So we would need to take a look at the transmission mechanism. But we think India needs more easing, and it'll probably rely on inflation as well. To what extent we see a stabilization in inflationary pressures, which have been picking up for the last few months.
What is your concern there? Would that be a spanner in the works if the RBI were to ease from here?
Not necessarily. I mean, from a global perspective, clearly commodity markets have been a lot more stable than I think the majority of investors were expecting. Generally, people have been expecting, crude prices to move back up to maybe the sort of 40 or 50 level, and clearly that's been more stable. So that will help regional and Indian inflation remain, a little bit better anchored, and that will provide more room to central banks, including the RBI, to be able to ease policy. For India, of course, food inflation is a key one, and food inflation has been picking up, so they'll be looking very closely to see what happens with food prices over the next few months.
Do you think the Indian bond market looks more attractive, Indian government bonds look more attractive than elsewhere in the region?
Not just elsewhere in the region, but elsewhere in the world. Clearly the backdrop of commodities is not positive for a lot of emerging markets that are focused on commodities, but it is for India. So as a diversifier from some of that, India has still been a preferable
Would you be
allocation.
incrementally allocating to the bond market in India?
We actually already have a fairly healthy exposure to the market. So yes, we do have some room to increase, and there are some investments that we are looking at potentially picking up for some of our funds.
What does this budget do for the currency, which is now nearing record lows? And it's pretty much catching up with what we saw with other emerging market currencies for the better part of 2015. Does the currency go beyond 70, and is that good for India in terms of building exports?
There is a good chance that the currency could move above 70. It doesn't necessarily have much to do with the budget, but it really has everything to do with the general risk environment. India is also getting caught up in the general negative environment for emerging markets, even though it's a more domestically driven economy. Clearly, if the policymakers want to retain India's attractiveness when currencies are selling off to an extent, they have to engineer some degree of depreciation of the rupee as well. So we do think there's some risk of depreciation. Up till now, the total return opportunity, i.e. the return you get from bonds combined with the currency, has still meant that the Indian market is quite an attractive allocation.
Okay.
But we'd want to start seeing some stability in the rupee moving forward. And that could happen because you've got a much more healthy balance of payments position. So FDI flows are much, much stronger than they used to be. The current account deficit has come down.
But you're invested in some of the PSU banks, like you said, on the debt side. And you believe that your conviction with those investments holds, despite the fact that these banks are suffering from asset quality concerns and profitability is deteriorating.
Correct. I mean, to be fair, it's a very much smaller amount of our exposure. Most of our exposure is in the higher quality private banks, like an Axis Bank and ICICI.
Sure.
And some of the rest of the exposures are a lot of the finance companies, rural electrification company, and that sort of thing. But as long as they continue to receive strong government support, then we wouldn't have any major concerns with the potential for these holdings.
So, Ken, before we wrap up, do you think that, in summary, this has been a balanced budget, something that's not rocked the boat, that the government has been pretty much taking a ride on to ensure that foreign investors, domestic participants feel at ease about the path that they've taken on fiscal consolidation, on growth, on reforms?
I think so. I mean, there'll still be a very close look at the numbers to see, given all the additional spending, whether they really can achieve that 3.5%. So we'll have to go away and take a very close look at that. But most of the things were in line with expectations. So obviously, given the pressures in the rural sector, both from an economic as well as political, and maybe the political aspect is more important, given the upcoming state elections, the additional support for the rural sector, for farming, agriculture, was very much in line with expectations. But when you combine the commitments that would be required for these programs, combining that with the 7th Pay Commission spending and some of the other
but
things.
a lot of that was in the public domain. So,
Correct.
Those announcements have been pretty much in line with expectations.
In line with
so
expectations.
Has this budget been more, reassuring for investors that, look, we are not going to do anything that's going to derail the India story or surprise you on the negative?
Yeah, for sure.
We're going to pretty much run past expectations and make sure that we deliver as we've stated.
Yeah, definitely. There was no major surprises, negative or maybe even positive in the budget. So yeah, it was a fairly safe budget.
But as a long-term investor, are you convinced of your investments in India, and does this budget reassure you that India is on track?
We're still positive on the India story, and for us, we're very long-term investors, probably more long-term than an average investor. So we're able to look through a lot of the noise, and we realize there are obstacles in the way. But to be honest, the economy has made a lot more progress than people perhaps realize. And one of the reasons for that is a lot of the progress has been made at the state level, which maybe is a little bit more difficult for people to view. But we're still very positive, and when you look at corruption at high levels of government, which has practically disappeared. There's many of these sort of stories that have happened that maybe don't get discussed widely enough that leave you feeling pretty positive. And every time we travel up there, and we go up there 3-4 times a year, we are made perfectly well aware of the challenges, but nearly every policymaker you speak to, either at the state level or central government level, they're all very well aware of the challenges, but you now have a very reformist government who not only is aware of the problems, but knows how to tackle them.
Great to have you on the show. You heard the finance minister, you saw the budget. What do you make of that target of 3.5% for FY17? Is it a surprise that they kept it intact?
Positive surprise. We thought that they would probably let it go a little bit, especially since the past few months from the finance ministry, we have been getting some signals that given the global environment, it might make sense to weaken the fiscal stance a little bit. So they maintain their resolve. That's impressive. Now, is the budget fully realistic or not is a different question. Looking at the numbers...
Do you think it's a realistic number, that 3.5 could be met next year?
Let's put it this way. It's more realistic as a target for 16-17 than it was for 15-16. The fact that they're achieving 15-16 is a bit of a function of luck. The decline in fuel prices allowed the government to push up the excise taxes. Whereas going into 16-17, I think that there's some risk that the budget is once again too much reliant on disinvestment revenues. We're looking at about 0.4% of GDP worth of target. Given the problems they've had this year in terms of privatization, it's not very clear to me how they can be optimistic that they can do another 0.4 next year.
Also, revenue growth of 14%, do you think they can make that?
Yeah, there are two issues here. One is probably not on the tax revenue side, which was very weak last year, again reflecting weak economic activity. But at the same time, the 11% nominal GDP growth projection, that would make nominal GDP the fastest growth in the last 3 years. So not just this year with the deflator in negative, even the preceding year was lower than this. So again, one is looking at a fairly optimistic view on inflation dynamic and global demand to come up with 11%. So that to me would be risk two. First being the disinvestment assumption, second being the GDP growth assumption.
So at this point in time, while this announcement has been made, and it's a clear headline, right, coming in from the government, do you think that they could stand by their commitment to the fiscal consolidation path that they had laid for themselves last year?
Well, I'm fairly impressed that not only do they not waver on the budget target for 16-17, but even for 17-18, 18-19, the 3% target was articulated by the finance minister. So clearly the government thinks that regardless of the imperative in terms of the wage commission, banking sector restructuring, or investment in infrastructure, they need to maintain fiscal discipline. So I'm pleased to say that both the RBI and the central bank now are fully on the same page on this issue, and that's a heartening development.
More rate cuts from the RBI then?
At least one. Beyond that, we have to see what happens with the CPI. Mind you, the latest few data points on CPI have not been particularly comfortable. Core is stuck around 5. Sure. The non-commodity, non-food prices are rising at 5 to 7%. So I don't think that would give Governor Rajan a lot of confidence that he has firmly and decisively won the inflation battle. So I think that price developments would have to be on a sustained basis more favorable. One rate cut, very likely, maybe this week or in April. But beyond that, we'll have to wait.
But so one rate cut added to the 125 that's come into the system thus far, plus some push coming in from the government. So both fiscal and monetary support extending out to the economy. Do you think that'll do the trick in terms of getting the growth numbers? Because, you know, the headline numbers may seem like 7.5%, but when it trickles down to the internals, earnings growth has been lacking. Now, do you think that picks up? Because you're still looking at underutilization in the manufacturing sector. Demand still remains weak. Yes, they've pushed infrastructure investment. They've pushed for that. But in the overall expenditure numbers, do you think the commitment has been strong enough to bring about those growth numbers?
Right, so it's a tough situation. And as you correctly say, that between capacity utilization and the production numbers and very poor export numbers, manufacturers in India by and large are facing a very challenging time, and it's been going on for a year and there's no end in sight. So from that perspective, I suppose if the government had committed to a bigger recap of the banking system or had given some relief to the exporters, the market would have cheered. But I think in some ways you could argue that the quality of fiscal adjustment is geared toward the medium-term view, not just a short-term relief for the economy. So maybe it doesn't support growth in the very short term, and maybe the equity side may not be that impressed, but I think it is laying the foundation of sustainable growth for the next 5 years or so. So from that perspective, we'll take a patient, optimistic view, as opposed to taking an exuberant, impatient view.
Does this mean the currency gets weaker from here? And if so, by how much?
Right, I think the currency is a global beta right now. EMFX is out of favor. Given the inflation number we saw out of the US on Friday, again, there'll be renewed pressure on the currencies around the world, I think. Rupee will be no difference. But from a fundamentals perspective, of course, India is in a far better plane now than it was a couple of years ago, whether it is reserves or just the overall flow dynamic, the amount of FDI that is coming in. So I'm not particularly worried about the rupee. Little weakness is possible given what's happening in the world, but we're nowhere near the 2013 situation.
And what about yields? Because the bond markets today rallied, yields fell a bit. Where do you see the target there? Because, as you're saying, 3.5, yes, it's impressive that they've kept their commitment, but it would be a bit of a challenge to meet that mark.
Right, and also, it's been a very strong fixed income story for the past couple of years anyway. Only lately we saw some concerns on investors' part, and therefore we saw some firming of the yield. Mind you, there are two elements to the fiscal picture. One is the central government, other is the state government. The states are also showing a great deal of stress. On a consolidated level, whether there will be a tangible improvement in the fiscal stance, we don't really know. And mind you, states also have electricity sector restructuring related spending. They will also follow the wage commission and push up their wage bill. So consolidated level, we're not sure yet. So if you're looking at just from central government Gavi issues perspective, it's fairly okay. But from a consolidated perspective, the jury is still out.
The jury is still out, but what's your verdict on the budget, Timur? Overall, do you think, including, the recapitalization plan, which has undershot the expectations from the market, but, they're saying this is work in progress, right. And, there could be, on a case-by-case basis, privatization also considered for some of the ailing PSU banks, consolidation for the sector, that is. What would be your verdict?
So I would summarize this budget as a do-no-harm budget. I don't think it did anything that would spook investors. It was not like a slam dunk budget in terms of major structural reform measures that would get the market very enthused. Mind you, there was no mention of GST, and I'm sure that's a bit of a disappointment. Well, all in all, as I said earlier, we thought they would actually slip. They didn't, and that's a good takeaway.
Did they make the most of the opportunity? Because this was a more critical budget than last.
Now you're forcing me to be a bit critical. Clearly, the oil windfall has been so substantial. One could argue one could have made more out of it. There wasn't much progress in terms of dealing with fertilizer subsidy and food subsidy. So you can always pick and choose. But let's also not forget, it's a very tough global macro. You don't want to put too much medicine on the economy when already things are fragile. It could actually undermine the recovery. So it was a very tough tightrope to navigate. I think they've done a pretty good job.
How would the world be watching India's budget in lieu of what's happening globally right now, where there's search for growth? Export is a tricky zone because global trade is slowing. So a lot of countries, including the US and China, are trying to build their domestic consumption. India is, in an advantageous situation because of that. So what would the globe take away from this budget in terms of India's profile as an investment destination?
Right. As you know, budgets are a very big deal in India, but they're not a very big deal for the rest of the world. It's just a normal process. Annually, they come and go.
But expectations were high from this government, right?
Right. And so from that perspective, I don't think the government should restrict all its reform measures with the budget. It'll be a rolling set of measures. As you pointed out, that the government is also saying that just because they haven't added more money for banking sector recapitalization, that doesn't mean there won't be anything done in terms of course correction later on. Yeah. So as long as the signal is they're flexible, they're looking at what's happening with the economy, it'll be a good thing.
Timur, thanks very much for speaking with us. Thanks very much.
Find us on Facebook at facebook.com/ETNOW and don't forget to click the like button. You can also follow us on Twitter at ETNOW Live. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNOW.